An adjustable mortgage interest rate is a type of mortgage loan where the interest rate can change or adjust over the life of the loan. The adjustment is usually based on a certain financial measure, like the U.S. prime rate or the London Interbank Offered Rate, LIBOR, plus a margin that is set by the lender. In contrast to a fixed-rate mortgage, in which the interest rate stays the same for the entire loan term. An adjustable-rate mortgage's interest rate can change over time. Instead, with a flexible mortgage interest rate, the rate can change at regular times, usually once a year or every few years. In the mortgage deal, the terms of the adjustment and how often it will happen are written out. Usually, there are caps or limits on how much the interest rate can change during each adjustment period and over the whole life of the loan. Here's an example of adjustable mortgage interest rate. John decides to buy a house and gets a 5/1 adjustable rate mortgage, ARM. The 5/1 is the original fixed rate period and how often the rate changes. In this case, John's mortgage has a set interest rate for the first 5 years, after which the rate will change every year. For the first 5 years, John's adjustable rate mortgage, ARM, has an interest rate of 3.5%. Throughout this time, his monthly home payments stay the same. But after the initial fixed rate time ends, the interest rate will change every year, based on an index and a margin that have already been set. The reference for John's adjustable rate mortgage, ARM, is the U.S. prime rate, which is currently 4%, and his lender has a margin of 2%. If the prime rate goes up to 5% after the 5-year fixed rate time, John's interest rate will change to 7%, prime rate plus margin. This will affect John's monthly debt payment. If the interest rate rises, so will his payment. On the other hand, if the interest rate goes down, John's payments will go down. Adjustments are made every year for the rest of the loan's time. It's important to note that the specific terms and conditions of an adjustable mortgage interest rate can vary depending on the mortgage product and the lender. Borrowers should carefully review the terms and understand how the adjustment is calculated, the frequency of adjustments, any caps or limits on rate changes, and the potential impact on their monthly payments. Adjustable rate mortgages can be beneficial for borrowers who expect interest rates to decrease, or who plan to sell or refinance the property before the adjustment period begins. However, borrowers should also be aware of the potential risks associated with rate increases and fluctuations in the housing market. Congratulations! You just learned something today from Real Estate World. Don't forget to subscribe for more real estate glossary. Thanks for watching.